Hey Bowtie Nation, Joseph Hogue here with a new series straight from you out there in the community. Steven in our Facebook group suggested a this versus that theme, matching up some of the most popular stocks against each other to see which is the better investment. We got some great stock requests like Tesla versus Amazon and Google, AMD versus Nvidia and Intel. And that's exactly what we're going to do. Compare some of the most popular stocks in a head-to-head grudge match for some of the best investments you can buy. If you want to suggest some stocks to compare, join the community by tapping that subscribe button and leave me a message in the comments below. We're starting strong this week with some of your favorite stocks to buy, including Amazon, Google, AMD, Nvidia, and Tesla. We're going to look through the analysis for each stock to buy and which one to throw out. Stick around though, and I'll show you how to compare these stocks to make sure you're always going to pick the best. I'm going to be using some research and data from Seeking Alpha for this video. If you want to check out more of that analysis, I've set up an exclusive deal for all you out there in the Bowtie Nation. I started writing for Seeking Alpha in 2011 and wrote for years before joining a venture capital firm, but I still use that premium access for ideas and analysis into stocks. Use the link below to try Seeking Alpha, and if you decide you like it, you'll get a 50% discount on that premium access. That's $120 off and the lowest price you're going to find online. In fact, it's lower than the price I paid for access when I signed up. But first in our this versus that stock picks is Amazon versus Google. And I'm going to start off with the sales growth to see which is the better growth company. So I've lined up the revenue growth, the sales growth for both Amazon and Google. Amazon up at the top there, Google on the bottom. And you can see they have both for revenue growth for year over year, so the last 12 months, as well as the forward expected revenue growth for each. Now, if you look at Amazon, you see it's grown at 9.6% over the last year against a sector median of about 12.2%. So it is growing slower than the sector average. It is also growing slower than the Amazon's own 5-year average, which was 27%. So quite a bit slower sales growth over the last year for Amazon. You see the same thing here for Google, although it is a faster sales growth, 18% sales growth for revenue growth for Google over the last year. Still under its 23% 2-year average, but well above the sector median. So it is actually beating its sector on sales growth. For revenue forward numbers, we do see both of them are expected to increase their sales growth percentage over the next year. So 13.4% for Amazon, 19% for Google. So Google very much more a growth company, very much expected to keep up those double-digit growth statistics. But one thing I think is very much underrated about Amazon and not yet reflected in the stock price is its ad revenue business. This is something that Amazon is really expanding into, and it's really going to move the stock forward versus maybe Google and some of its competitors in the future. You know, where we've seen Google and other social media platforms report very bad sales weakness or ad weakness in over the last year as companies pull back on their ad spending, then Google search, Meta, Facebook, all those social media platforms are reporting very much lower ad revenue from those companies. But Amazon is telling a very different story in its business. Amazon's ad revenue grew 18% to $8.76 billion in the third quarter from the year earlier versus just 12% growth for Google and a drop of 1.5% for Facebook. So again, we're seeing the search giant Google there, as well as social media platforms say that the ad revenue is slowing down, except Amazon's telling a different story. Amazon is actually benefiting from that, likely taking market share gains, right? That 18% sales growth for ad revenue at Amazon is likely meaning it's taking market share gains from those other two competitors. As of last year, Amazon held just 14.6% of the U.S. digital ad market versus 26.4% for Google and 24% for Facebook. So that faster sales growth means it's probably increasing that market share. Advertising is a high profit business, right? The highest in Amazon's business, right? Likely around 30% operating margin for that ad revenue business versus just 3% overall for Amazon's entire business. So it is definitely going to move the needle on earnings, and I think it's a growth segment that is very underrated right now for the stock. And while Google is expected to increase that pace of revenue growth over the next year, it is seeing a major threat in TikTok, not just for YouTube, but also for its core services like search and maps. An internal study by Google itself found that 40% of Gen Z were using Instagram or TikTok instead of its own maps or search function, right? It also referenced a stat of 55% of all product searches are now beginning directly on Amazon. I still think Alphabet or Google really has some good competitive advantages in its space in search and discovery. Alphabet still dominates that global search market with 80% of market share, but That's not set in stone as we've seen, right? Networks of products like search and maps and YouTube and Android, they all work together for that leverage, but we do see some other products like TikTok moving in and taking some of that search and maps business. We see Amazon taking some of that ad revenue business. Now, YouTube continues to be the jewel in the crown for Google, and I expect it to keep on growing. You've also got Waymo, the autonomous car unit that could generate tens of billions of dollars in the next decade, as well as smart homes from Nest and healthcare from its Verily site. Against that, you've got Amazon with its advantage on Prime, which is really just a cross-selling machine from e-commerce to media and generates more frequent buyers, right? Anytime Prime can lock someone into a membership there, give them discounts on other things, then they're more likely to buy from those other parts like e-commerce and media and things like that. Another underrated segment for Amazon besides that ad revenue business, I think, is just its logistics infrastructure, right? Amazon is building out a logistics empire to deliver all this stuff that could someday create a new business. And I think someday all of these businesses together because right now Amazon is a conglomerate, okay? It's got this media, it's got e-commerce, it's got cloud, it's got that logistics segment as well as ad revenue. I think someday those are going to be split off into separate companies, and I think investors are really going to benefit not only as Amazon grows into all these segments, but also then when it splits off and creates these different businesses and different shares, right? E-commerce is still less than a sixth, about 15% of total retail sales, and while it has slowed after the pandemic, it is still in that long-term trend and expected to reach 21% of total retail sales by 2026. So you still have a lot of growth in that core e-commerce segment. On a valuation basis, and I cannot believe I'm saying this, Amazon is actually the cheaper stock, the less expensive stock, at a price to sales of just 1.74 times. That is about half of its long-term average. You see here the Amazon 5-year average of 3.74 on a price to sales basis. So currently 1.7 times, that is about half of that long-term average. Google trading for 4.1 times price to sales. That is still below its 5-year average. So both of these stocks relatively cheap compared to their own long-term averages. But Google is only trading at about a 36% discount versus that 53% discount for Amazon. So some of that faster sales growth for Google is reflected in a more expensive stock here in the price to sales valuations. And I think both of these stocks could be good investments over the next 10 years. With Google, you're basically paying just for that core search and YouTube segments, but you've got a lot of lottery ticket plays that can come out over the next 10 years. You've got Waymo with self-driving cars, you've got Verily in healthcare, as well as smart homes in Nest. So you've got a lot of upside options to the stock over the next 10 years. I have to give the edge to Amazon here in a head-to-head though. I think a lot of things in Amazon, a lot of segments are really just underrated right now, especially that ad revenue market that has those margins so much higher than its core margins. I think it's really going to deliver and surprise people on how much the company is actually making in earnings. We're going to compare your favorite semiconductor stocks, AMD versus Nvidia next, but all you out there in the nation know I'm not just going to drop a couple of stock picks in your lap and tell you to go buy these, right? I want to walk you through how we're comparing these, and so you can be a better investor and make your own comparisons. Now, you will notice most of these comparisons start off with really some basic fundamental analysis. I'm going to compare sales growth, operational profitability, and valuations for each stock to see how they stack up. For sales growth here, not only am I looking at the 3-year average that beats a company's direct competitors, but also the sales growth over the last year to tell me that the company isn't losing that momentum. A company growing its sales faster than competitors really means it's taking that market share from them, taking that part of the market from peers, really making it its own. It could also be a hint to some kind of competitive advantage the company has, right? Helping it to grow faster, but then it's pointless if it's not a competitive advantage that the company can defend. So that's why we're looking at the 1-year sales growth versus the 3-year to see if, maybe the company can keep up that rate of sales growth. Finding those sales growth numbers is really easy on Seeking Alpha. Under the growth tab there, you can compare the current year's growth compared to the 3 years. You can compare it against the sector average, and you can compare them head to head against other stocks. Then I want to do the same thing with the company's operating margin. That's the core profitability of the company, right? How much of its revenue is it turning into operating income? And again, here I want to look for companies with that long-term operating margin, that long-term 3-year profitability that's higher than competitors. And that means for one reason or another, whether it's management is just more efficient or the company has better pricing power, it's got some kind of an advantage that is making it more profitable. And of course, finally, even a good company can be a bad investment at the wrong price. So I want to consider that valuation on the price to earnings or the price to sales ratio. Folks, I am a cheap ass to my bones, but don't just think that a low price stock or a low PE ratio for a stock makes it a good investment. Usually, more often than not, it is cheap for a reason, and that cheap valuation doesn't necessarily mean it's a good stock to buy. Using these valuation measures is critical to finding the deals in stocks, but you have to use it with a combination of that other analysis, that fundamental analysis in sales growth and operating profitability to really find the best stocks to buy. In next week's video, I'm actually going to show you how to find the companies with that competitive advantage. So how to take this a step further from just those numbers, the sales growth, the operating growth, and the valuation to find companies with real competitive advantages over their peers. But back to our matchups, and now we're going to be looking at semiconductor leaders AMD versus Nvidia, ticker NVDA. And for sales growth here, this one really surprised me that AMD actually has the stronger growth, both on that 1 year and the 5-year average. Now, both are beating the sector median for sales growth, so that's good for both of them, for Nvidia and AMD, but AMD clearly has that stronger growth. You see here, over the last year, AMD has grown its revenues by 53.7%. That is well above the 17.7% for Nvidia. Over the last 5 years, AMD has also grown its sales by 36% a year, while Nvidia has grown it by 33%. So still a very strong sales growth, but lagging AMD in the revenue. Here in the profitability measures, we do see stronger margins for Nvidia, though both companies are also beating the sectors again. Here I'm looking at the EBITDA margin, which is going to be pretty close to your operating margin statistic. For AMD, you've got 24.3% operating margin or EBITDA margin over the last year versus 30.5% for Nvidia. So Nvidia does have the clear leadership here in profitability. That works out over the 5-year as well. So we've got 35% in EBITDA margin for Nvidia over the last 5 years, AMD at just 15%. Now, what I do like here is that AMD is actually improving on its profitability. We see over the last 5 years, AMD booked a 15.4% EBITDA margin, that profitability in earnings before interest and taxes and depreciation. And it's grown that to 24% over the past year. So it is actually becoming more profitable, cutting those costs, whereas Nvidia is slowing down a little bit or becoming less profitable. Nvidia over the last 5 years has an average of 35% that EBITDA margin, that profitability. Now it's only 30% over the last year. So something is happening there at Nvidia that it is becoming less profitable. Those costs are going up while the revenue is slowing down. But on a valuation basis, AMD is much less expensive. And I'm looking at the middle row here, that price to sales ratio. For AMD, it's trading at 4.1 times on a price to sales basis. That is a 39% discount to its 5-year average of 6.8. For Nvidia, you've got a price to sales of 12.9 times. Now that is a 23% discount to the 5-year average of 16.8, but it is still very high. It is still very much growth territory. Both of these stocks, as growth stocks, they are trading in that growth territory for valuation for price to sales. They're both trading very well over the sector median, but you would expect that given their fast sales growth, right? You would expect with that kind of double-digit sales growth, they're going to be trading at a higher price to sales basis, but you would not expect something like maybe a 12.9 times for shares of Nvidia. And that's why I think I've got to give the win here to AMD, right? First for that faster sales growth, second for not necessarily the better operating part profitability, the better margins, because we did see that Nvidia is operating at a better margin, at a better profitability than AMD, but AMD is improving its operating profitability, its profitability over the last 5 years. So it is getting more profitable while Nvidia is lagging a little bit for some reason. And then that valuation is the big one for me. You know, I can get a share of AMD for about a third as expensive on that price to sales ratio as Nvidia. So I can get stronger sales growth at a cheaper price. I got to give it to AMD for this one. We still got the big matchup, Tesla versus Amazon next, but I've actually found a group of stocks that might just save your life. Check out the video here. I'll link it in the description. 7 stocks to buy that could save your life this year. But here we have it, Tesla versus Amazon. And we're going to start off with sales growth. We've already looked at Amazon's growth, with this really disappointing recent growth, but strong sales potential. And now we see that stronger growth from Tesla. Really no competition here. 60% year-over-year growth in revenue from Tesla. That is actually higher than its 5-year average, higher than the 49% average over the last 5 years. It's 21% higher. So Tesla is not only growing at that high double-digit pace, but it is also doing it on an increasing basis. I got that momentum in sales growth. But that revenue growth is expected to slow down. Here we see on a forward basis, it is only expected to grow 52% over the next year. Still very strong growth, but I wonder if that is even a little bit too optimistic. Now, we do have estimates for units sold out of Tesla through 2030 with 5 million vehicles by 2030. According to Morningstar, that would be about a 17% annualized pace from 2023, right? In 2023, the company is expected to post about 1.6 million vehicle deliveries. Now, of course, that 17% annualized pace would be well off the current pace and even the pace of the disappointment in 2022 deliveries, right? 2022 deliveries were actually up 47%. That is off of the 50% plus pace the company has reported in the past. And what worries me here, at least for the near term for Tesla and its production numbers, is it used a lot of incentives. It used a lot of cash back. In fact, historic cash back incentives to get customers to come in, place their orders in 2022 versus waiting to 2023 because it knew it was going to miss a lot of the expectations for its orders growth. So I think it brought forward a lot of those orders. It brought forward a lot of production in 2022, and I think those first few quarters of 2023 could be a disappointment on how many orders it can produce. Here on a valuation basis, and again, I'm looking at the middle row here, this price to sales valuation. Here we see Amazon trading for 1.7 times on a price to sales basis. Again, that is about half as expensive as it has been over the last 5 years. Here we see Tesla trading for 4.7 times on a price to sales. So more expensive, but still about a 52% discount to its long-term average, right? Over the last 5 years, we do see here that Tesla was trading at about 9.9 times on that price to sales basis. So both of these companies stocks trading at about half the valuation they have traded over the last 5 years. But one thing we need to consider when trying to compare these head-to-head, Tesla versus Amazon, is you really can't do that. You really can't compare the numbers head-to-head against these because they're in such different businesses, right? They're both tied to that consumer spending, that consumer discretionary market. Amazon with e-commerce, cloud, that kind of thing, and then Tesla with electric vehicles. Those business models are just so different that you really can't compare the growth, the margins, the valuation. You really have to compare them against competitors in their own segments. So for Amazon, you would want to compare those numbers against its peers in its space. Maybe for e-commerce, you would compare it against Etsy. For cloud, you would compare it against Microsoft. And we can just look at the valuations here and scroll down on the statistics page for Yahoo Finance. And we can see the price to sales for Etsy, that other e-commerce player, is 6.5 times. So that is well and above what the valuation, the price to sales ratio of 1.7 is for Amazon. Now we can go here to Microsoft for a little bit more of an enterprise model, cloud services. We can see here the price to sales is even higher, 8.3 times price to sales valuation for Microsoft. So we can see that compared to its more direct peers, compared to its more direct competition, Amazon is trading at a very steep discount at that 1.7 times on a price to sales basis. For Tesla, we want to compare these numbers against other automakers, some of the traditional automakers like General Motors here, some of the electric vehicle makers like Rivian or NIO. And if we scroll down here, we find a price to sales for General Motors of just 0.36 times. So less than a tenth the price to sales valuation, less than a tenth the expense that we would have to pay for shares of Tesla. It's a different story, obviously, though, for Rivian and some of those all-electric vehicle makers. Scroll down here and we see the price to sales for Rivian of 14.5 times. So actually more expensive than a share of Tesla. So Tesla is not necessarily in its competitive field, not necessarily very expensive or very cheap. One thing I do want to point out when talking about Tesla is a lot of the valuation here is going to be based on its self-driving features and the potential in an autonomous taxi. If we look here at ARK Invest's expectations or their share price target for Tesla, obviously this is before the 3-to-1 split, so it's not $4,600 a share per share target just yet. But if you look at their targets, their bear case and bull case, you come down here. They're expecting Tesla to be able to sell up to 10 million cars by 2026. Obviously, I think that is way out of the realm of possibility. We just saw that Morningstar estimate for about 5 million cars by 2030, so I doubt that Tesla gets anywhere near to even 10 million cars by 2026. So already you have to kind of take these valuations and these price targets with a grain of salt. They've got the average selling price that they think Tesla will get to in here, electric vehicle revenue, and then look at the next two lines here, this human-driven ride-hailing revenue, this autonomous ride-hailing revenue. This is over $110 million that the company expects the Tesla to be able to generate by 2026 from these two segments, right? From that self-driving feature used in autonomous rideshare cars, as well as just the human-driven ride-hailing network. So a lot of those expectations, a lot of the price upside built into shares of Tesla is kind of hinging on that self-driving feature, as well as some kind of a ride-hailing service that they come out with over the next few years. Now, I will say this is the toughest matchup because there's really so much uncertainty in Tesla, right? On production numbers, on orders, on that self-driving, and really electric vehicles in general. I do believe that given 10 years, Tesla can produce the higher returns versus Amazon, so versus the two, but it's going to be with a lot more risk and a lot more volatility. And part of it is just the numbers here, though, right? Electric vehicles account for just about 3% of total car sales, so there is a lot of upside left over the next 10 and 20 years for that to grow. E-commerce still has a lot of room to grow. Cloud still has a lot of room to grow as well, but not to the extent that we see in electric vehicles. And this one's really going to be kind of a personal preference and how much risk or stress you want in your portfolio, right? I'm a lightweight when it comes to risk, so I'd probably give the win to Amazon here because I think it's just a much less volatile and much less uncertain stock. I don't need that stress. I don't want it. So yeah, again, I'd probably go with Amazon. Maybe a slightly lower return, but still very respectable. I think a double-digit high return for shares of Amazon. But if you want to accept that risk and the stress, then maybe Tesla is a better investment for you, but you've got to be willing to hold on for the ride. Let me know in the comments which stocks you want to see compared next, or click on the video to the right for the 7 stocks that could save your life. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.